For many investors, ARCC Capital is a great dividend income stock. And with a dividend yield of 8.3%, I totally get that. And this is also the reason why it is in my portfolio. As a matter of fact, ARCC is one of the highest paying dividend stocks for me. Looking at the 1-year chart, we see that ARCC found some momentum lately. And this begs the question, is ARCC stock a buy at current prices? Well, let's find out by doing a quick peek at the recent earnings, a fundamental analysis, and last but not least, checking the price targets. So without further ado, let's dive into it. On the 30th of October, ARCC reported earnings with a beat on revenue, but a miss on EPS. And for the upcoming earnings, it is expected to miss their earnings as well, based on the analysis estimates. Diving a bit more into detail, we see that net income per share was reported at $0.62, down significantly year over year, when it was reported at $0.89. But keep in mind, it is up big time versus the previous quarter, when it was reported at $0.52. Core EPS was reported at a similar number. The portfolio investment was reported at nearly 26, up big time year over year, and so were the assets. Net assets per value increases as well, which is all looking pretty good to me, and the same goes with the debt to equity ratio. Looking at the dividends, we see that they are at a similar level year over year. The good part is that the dividends are safe, with an EPS of 1.78 and dividend declared at $1.44. Looking at the portfolio diversification, we see that the top 15 investments make up for 26% of the total portfolio, which comforts me a lot, especially since the biggest investment is only 7.5%. Looking at the industry breakdown, we see that the software and services make up for 25% of the portfolio, which is a bit on the higher side, since I prefer a maximum of 10 to 15% here. But it has to be said that this type of industry is really future-proof, so I don't mind that much. Looking at the backlog industry breakdown, we see that the healthcare services is the biggest, together with again software and services. Also looking pretty decent to me. They tend to focus on these two industries. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. ARCC Capital is a 14.8 billion market cap company. PE ratio is at 9.4, indicating that they are undervalued. Later in this video I will show you my 3 price targets for ARCC Capital stock, so make sure to watch until the end, because these price targets might surprise you. Revenue is at 1.76 billion, and in this graph we see that revenue went up in the long run at a pretty steady and consistent pace. Both the operating margin and net margin are going up and down a lot, but as of lately the net margin is going down again, so this is something to keep our eye on. EPS is also going up and down quite a lot. I would love to see a bit more steadier pattern here. But it has to be said that companies like ARCC tend to have more fluctuations in their EPS. Analysis expect that EPS is going to decrease from here, which is very interesting. So let's keep an eye on this number. For the revenue analysis expect there will be little to no growth in the coming 2 years. Again, let's keep our eye on this number. Return on assets is sitting at 6%, which is a decent number. Return on equity looks really good, and current ratio is at 1.29, which is a great number. It is also pretty steady historically, so this looks good to me. Right now, ARCC Capital has 13.6 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. ARCC Capital has a shy 500 million in total cash, so they can't pay down a big chunk of their debt. To me, this doesn't look good, but it has to be said that companies like ARCC tend to have higher debt than other companies. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And ARCC is hardly generating any cash flow, so this is a potential problem for the company. So the easiest thing to generate more cash flow is issuing new shares, and that is exactly what ARCC has done in the past. Shares outstanding are increasing over a longer period of time. But when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 8.3%, which is a great number. Annual payout is at $1.92 and payout ratio is at 80%. I prefer 50% or lower, so right now they have only 20% left in cash to buy back shares, pay down debt, do acquisitions and all other things. But it has to be said that for companies like ARCC it is very common to have a higher payout ratio given their dividend yield. And now it gets really interesting. The 5-year growth rate is at 4%, which is a decent number, and there is no dividend streak. And if you take a look at these numbers, the dividends paid since 2015, you see that ARCC Capital did increase the dividends at a decent pace historically. But in 2020 they decreased the dividends due to the lockdown periods, and from there they increased it once. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that historically it looked pretty good. It is coming down, which is the thing that I like the most here. In this graph we see the expected dividends in 2025 and 2026. Of course, this is an estimation that can be highly impacted by results, but it gives you a rough indication. It's expected to stay flat. And overall these dividends look really interesting to me, but how about the historical returns? I decided to compare ARCC stock with the overall market, in this case the S&P 500. Next to that I added OBDC and Main Street. On the 5-year chart we see that ARCC beats the S&P 500 by a slim margin. Main Street had the highest return, which is pretty impressive. OBDC has the lowest return with only 62%. And keep in mind this graph is including dividends. On the 1-year chart we see that things are changing, with a 26% return for ARCC and a 28% return for the S&P 500. And again, Main Street is having the highest return and OBDC is having the lowest. On the 6-month chart it is again a complete different story, with ARCC having twice the return of the S&P 500, really finding some momentum. Main Street is also doing an amazing job with 24%. On the 1-month chart it is again ARCC who is the winner. So bottom line, ARCC Capital beats the S&P 500 in the long run, and in the short run it also looks pretty good. So could this be the perfect time to buy ARCC stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. Starting off with revenue growth. For the revenue growth I'm filling in 4, 6 and 8%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 87, 89 and 91. For the free cash flow margin I'm putting in 10, 12 and 14. For the PE ratio I'm putting in 7, 8 and 9. For the price to free cash flow I'm putting in the same numbers. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety here. And right now ARCC Capital stock is at $23. I hit analyze, and we see a few green numbers, and I'm more focusing on the multiple earnings value. We have a low price target of $20, we have a mid price target of $24, and we have a high price target of $29. To me, the mid to high price target is the most justified here, telling me that this stock is undervalued based on these numbers. Which price target do you think is the most justified? Let me know in the comments down below. My final conclusion on ARCC Capital is that it is a high risk and potentially a high rewarding company. There is no denial in dividends being awesome. Looking at the fundamentals, you are going to find a few problems, such as debt and free cash flow. But other than that, it looks really good to me. And as said a second ago, dividends are amazing. And that is how I look at this company, a pure dividend income play. And I'm planning to expand my position anytime soon. I wish we would see some minor dividend increases. But to be honest, 8.3% dividend yield with only a really small window to increase those dividends is probably fine by me for now. So what is your take on ARCC? Please let me know in the comments down below. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.